Hi. In a previous video, we covered moving averages and described how they are important for providing useful information on momentum, for entry and exit points, and also for identifying trend reversals. Today, we want to add another trading tool to your trader's toolbox because different indicators should be used in different trading environments. So today, we are going to be covering Bollinger Bands. Bollinger Bands are a useful technical indicator that were developed by John Bollinger. They are good for identifying market volatility and for when markets are oversold or overbought. So what are Bollinger Bands? Bollinger Bands are essentially a simple moving average in the shape of a channel rather than a single moving line. They combine the characteristics of both simple moving averages and of channels, and so they provide good information on momentum and support and resistance. Bollinger Bands are essentially plotted as three separate lines: an upper band, a middle band, and a lower band. The middle line of the indicator is a simple moving average. And most charting trading platforms or charting packages default to a 20 period, which is fine for most traders, but you can experiment with different moving averages after you get a little experience with applying Bollinger Bands. The lower and upper bands by default represent two standard deviations above and below the middle line or the moving average. The concept of standard deviation is basically how spread out the numbers are or the price action is. If the upper and lower bands are one standard deviation, this basically means that about 68% of price moves that have occurred recently are contained within these bands. If the upper and lower bands are two standard deviations away, this means that about 95% of price moves that have occurred recently are contained within these bands. What do Bollinger Bands tell us? Bollinger Bands are very good for anticipating the crowd's moves. Like moving averages, they're plotted by an objective calculation, so everybody would be seeing the same thing that you're seeing and would be identifying the same support and resistance levels. This means that if the price hits the upper band, it is considered overbought, and if the price hits the lower band, it is considered oversold. Bollinger Bands also tell us a lot about momentum. When the bands widen, it means that there's a lot of volatility in the market, whereas when they narrow, it means that the price is moving in a relatively stable range. This means that if the price is continually testing the upper or lower bands or breaks past one of them, momentum is very strong. There are two different Bollinger Band strategies. Firstly, you have the Bollinger Bounce. The most important thing you should know about Bollinger Bands is that price always returns to the middle of the bands. And this is the whole idea behind the Bollinger Bounce. This means that if the price jumps to the top of the band, it'll eventually return to the middle. And if it hits the bottom band, it'll return to the middle too. And the reason that these bounces occur is that Bollinger Bands act as dynamic support and resistance. Many traders have developed strategies that thrive on these bounces, and this strategy is best used when the market is in a range and not in an up or down trend. You want to avoid trading the Bollinger Bounce when the bands are expanding because this means that there's more momentum and possibly a trend forming. The second strategy is the Bollinger Squeeze. The bands start to squeeze together when there is about to be a price breakout. On a graph, when the candles start to break out above the top band, then the move will usually continue to go up. And if the candles start to break out below the bottom band, then the price will usually go down. Conversely, the wider apart the bands move, the more chance that volatility will decrease, and it could be an indicator to exit a trade. However, you should note that these conditions are not trading signals, and it will not tell you which direction the trend is going to move. And this brings us to an important limitation of Bollinger Bands. As support and resistance levels, they are only effective in range-bound markets. As we said before, Bollinger Bands stretch to incorporate most of the price movements, or 95% of the price movements, if you are using a standard deviation of 2. However, it assumes that all measures of the sample, i.e. all of the 20 previous price movements, are equally probable. This assumption works for flat range-bound markets, but it does not take into account very volatile or trending markets. John Bollinger suggests using moving average with other non-correlated indicators. His favorite techniques are relative strength index and MACD, or moving average convergence divergence. Overall, Bollinger Bands are good for identifying whether markets are oversold or overbought, and they're also very good for identifying volatility in the markets. Thanks for watching. If you have any questions, please send them through to us. We are very happy to answer any of your trading related questions. Our website is fxscouts.com.